Hello, welcome to It's Your Smarter Money with Atlas Fiduciary Financial. I'm Dr. Laura, and with me is Professor Steve. And today we want to talk about the asset class called alternative lending. Now, alternative lending is very, very interesting because it actually has a little bit of an artificial intelligence play. When it comes to artificial intelligence, we've talked about the fact that there's a lot of speculation going on, and we don't recommend that. However, if you could find real places where they're able to apply artificial intelligence, now that's very interesting. And what we're finding is that this asset class is benefiting from artificial intelligence and cloud-based computing to serve borrowers better. And this method of borrowing is becoming mainstream very quickly and benefiting everybody involved.
Yeah. And I want to mention once again, this is a place where we try to add benefit to our clients' portfolios by finding these non-traditional asset classes and asset classes that would, as we'll show you later on, really help portfolio because they're not correlated with other holdings in the portfolio.
So in the past,
go ahead, Laura. Sorry.
I was just going to say, in the past, most small business owners, most people that were looking for small loans would have to go to a traditional bank or even a credit union, and they would request money from the bank, and the bank would get their money from savers who would give money to the bank, and savers specifically gave money to the bank and would earn a small interest. They would deposit and they would withdraw money, and the withdrawal would often consist of also a small interest amount. Now we're getting some interest. Over the past recent history, there wasn't that much interest that people were getting, but the point here is that the bank is right there in the middle. They're an intermediary, and the actual borrowing that's happening, the actual lending that's going on, is not benefiting the people that are providing the funds to create those loans. And so, in an alternative space, what happens is we're almost removing that intermediary where the actual people that are lending the money and that are putting the money in so that these loans can be generated are actually receiving some benefit from that.
Yeah, and the other aspect of this is that in this particular investment we're talking about, which is Lendex, a mutual fund issued by a company called Stone Ridge, banks don't want to go near these small loans any longer because of the underwriting costs and the servicing costs, the cost to originate. So it's hard to get a $7,000 or even a $10,000 loan from a bank these days. They're just not really efficient, a lot of the banks, and a lot of them I don't think really have adopted some of this new technology, this artificial intelligence, which can help actually underwrite these loans and sort of determine who's a good risk from a loan paying standpoint. And a lot of times it goes beyond FICO score, by the way, too.
And so this picture, if you compare the picture that Steve just showed you with the traditional bank, where we had savers, individuals who are savers, instead now we have investors who are not just receiving interest back, but they're actually getting interest from the loan, which is a lot different. They're actually participating in the benefits of these loans that are being made from the borrowers. So it's a very different story. Yes, we have different platforms like LendingTree and SoFi and even the Funding Circle, those types of platforms that are enabling this to happen. But instead of them taking all the profits, they're generating profits that go back to the actual investor.
That's right. And so the return to the investor is much higher than the interest that a depositor would receive. And this fund is clearly benefiting from that. And
something, Steve, I think it's really important for people to understand. There's the asset class decision that we're making on whether we want to be in alternative investments, period. Yep. And then there's the decision on what security we want to use. And they're separate pieces. And so right now, I think we're focusing on whether we want to even be in the alternative lending space.
Yep.
And then we went to seek and look for what types of securities would actually offer that. And that's how we actually found Lendex.
And surprisingly, it's almost a one-off. There hardly are any other options in this area. Now you can go into these direct loan vehicles that actually loan to small companies. But the risk is very different. In effect, you're making subprime loans to small companies, and they're quite risky. And you may only have maybe 80 loans behind one of those ETFs or mutual funds. Here it is 300,000 or 400,000 loans in this particular vehicle, which is astounding. So it's enormous. It's really diversified.
Again, though, we see this as really one of the only choices because of our due diligence and what we require a fund to offer. So we wanted to make sure that it was a 1940 Act fund, that it disclosed information, and that it behaved in a certain way, that the expenses, it does have internal expenses that are higher than, for example, your standard ETF for large cap stock, for example. But for the type of work that it's doing for us, the expenses are actually quite low. It's almost half of what you might see in other types of alternative types of investments.
And once again, it's because of technology. I mean, the ability to administrate and service 300,000 loans efficiently really be only because of computers. You would not be able to do that efficiently and in a cost-effective manner if we didn't. The technology that now exists did not exist. So some of this we actually covered already. We mentioned banks don't want small loans; they're too costly. And the other aspect here is that a lot of these alternative lending platforms, they already have a lot of data on the entities, the people or the small businesses to which you're offering loans. And I'll give you an example. Like, for example, Square, a company might receive credit card payments through Square. So Square has a good feel for the cash flow of that small business. So right off the bat, part of their underwriting job has been completed because they have a good feel for that. They can see their net cash flow in relation to their expenses. So they have a good handle on it already. So they have a lot of data. And the lending is done electronically. You're not sitting down at a desk in front of you in some big office. So that keeps costs down as well. So, and as we mentioned, there's lower cost of research to borrower. Artificial intelligence is a big and impactful technology here.
Yeah, it's a tremendous benefit to borrowers, right? Because borrowers who have small loan requests often have to go through a lot of paperwork and, providing banks with their reasoning, and they're being held to certain standards, whether they be credit scores or how long they've been in business or what they're actually investing in. And oftentimes they could get, after a very timely period, they can be turned down. So this is a way for borrowers to get access to funding very quickly for even emergency types of things, or maybe they have seasonal cash flow problems or those types of things. So it's great for borrowers, but it's also great for investors because now we're also able to get access to these individuals through these different types of platforms, peer-to-peer lending, and their mechanics. They have all this information available to that we're able to get access on these individuals, and we're actually having an opportunity to get higher returns with less risk. And then, of course, it's the aspect of diversification and finding other ways of diversifying away from the large cap marketplace.
But a lot of times the lending decision is made by these entities in 2 to 4 days. So people can get access to the loan quickly, which is really a benefit to the borrower as well. Okay, so oh, go ahead, Laura.
No, I was just going to say, this specifically talks to the Lendex choice. Go ahead.
Yeah. And so the symbol is LENDX. We normally call it Lendex. It has what we call an interval fund structure. And even though it's a 1940 Act mutual fund with daily pricing and so forth, it has daily liquidity in terms of being able, you can purchase it on any day of the week that the market's open. To liquidate the mutual fund, there are some restrictions. Stone Ridge, which is the firm that issues the security, will never liquidate more than 5% of their total assets under management in this fund in any 3-month period. And there's a reason because the partial illiquidity of these loans. For example, if 25% of there's a request for 25% of their holdings be redeemed, let's face it, they can't go back to these borrowers and say, well, we're calling your loans. So they have this 5% restriction, which means that if we, for example, ask to liquidate $100 and all requests from all shareholders exceed 5% of their holdings, we may only be able to see $80 of that request be liquidated in that 3-month period. So that's why it's called an interval. That's the interval fund structure here. So it does have some limit.
The duration of these loans is short. It's something in the neighborhood of it. I think maximum is like 15 months or so. Is that correct? So what they're waiting for liquidity. They're not leaving a lot of cash on the sidelines. They're investing all of it with these borrowers that are looking for funds. So it's not so much of an issue of, oh, I can't get access to my money. It's more about just timing. And so as long as we know that clients don't need access to this money right away, then we shouldn't be terribly concerned.
I think that's a great point. Yeah, I think that makes a good point. And also about the way the returns have been well in excess of the Barclays Aggregate Bond Index. And the Barclays Aggregate Bond Index is a combination of government, corporate bonds, and I think maybe mortgage-backed together. But we'll show you in a couple of slides further on, it's been well in excess of that. And we mentioned that it has a really low correlation with other asset classes, which means that adding it into a portfolio with traditional bonds and stock and other asset classes actually improves what we call portfolio efficiency, which means the ratio between return and the ratio to risk. So it makes the return of your portfolio either higher with the same amount of risk or have lower risk with the same amount of return based on how we structure it. And right now they have about $3 billion in assets in this fund, which it's quite a large fund at this point. As Laura mentioned, has a very low duration, 1.1 years. Small loans here. The average FICO range, at least for individuals, is in the 700 range, which is a pretty decent FICO score. And we already mentioned the low correlation. And here is a comparison of the return of Lendex, which is in blue, in relation to the Barclays Aggregate. And it's been somewhat flat this year. Lendex is maybe down slightly, but its return long term has been well in excess of the Barclays Aggregate. And we're going to show you in a slide later that its risk level has been much lower too.
And I do want to mention that the reason why it's this time period, the origination of this loan was somewhere around, was it 2015, 16? It originated and we were watching it. We didn't actually start using this fund until around 2020, right? I believe.
Actually, I did use it prior to that, but maybe not as much as we're using it now.
More wholesale in terms of really offering it to our clients. We like to watch how things are working. We also spend a lot of time talking to the actual fund managers, to the actual organization. I mean, once again, that's something that we are not necessarily recommending this fund for people that are doing it yourself. No. First of all, you can't even get access to it, quite honestly. It's an institutional fund. And so somebody that's a do-it-yourselfer might not be able to monitor the information. I think on the retail side, in terms of on the website, is limited, but for advisors, we're able to get access to a lot more information, and that's why it's important to buy this type of fund with an advisor who can actually monitor it and make sure that it is doing what we're expecting it to do.
Yeah, and we look at it frequently, and we do talk back. So I was on the phone with them just late last week with the fund company. We speak to them frequently, and we have access to a wealth of data through their website that only advisors can see.
And so this is a correlation table. Always difficult to really get your bearings when looking at a table like this. What we wanted to, first of all, show you is on the left-hand side are the different asset classes that we wanted to compare this alternative lending, which is number 7. And on the top, while it does not say the actual asset classes, 1 corresponds to real estate up on top, 2 corresponds to long short funds, 3 corresponds to developed international, and so forth across the top. So Steve, if you could click on the first, you can see that one of the comparisons here is large cap stock to alternative lending. And you can see that the correlation is extremely low. And so again, we're always looking at opportunities to diversify away from large cap stock. So that's a good reason why you want to include it. But in addition to that, if you click a second time, it's also not fully correlated with bonds either. And so we actually have, that's really positive when we can find something that's not correlated with large cap stock and not correlated with bonds. The third asset class that a lot of people hold is international. And even with international, again, it's not fully correlated. And if you look at the entire table, you can see that it's not really fully correlated with anything. But those 3 asset classes, I think, are the biggest asset classes that we want to make sure we're diversifying away from.
And I want to mention how difficult it is to find asset classes that are negatively correlated with each other. This is almost impossible to find. Very hard. You may find lower correlations, but to find ones that are this low or even negative is really, really hard.
Yeah, Steve, this time period here is 5
3
years.
years. I think it was 3. 3 years.
Okay, because we've had the conversation with our clients before that correlations aren't static, they're dynamic, and they change over time. And so while this is a 3-year period, not a great 3-year period if you think back to what's occurred over this past 3 years, and you know how correlated bonds and stocks became, so it's still quite a story. There will be times where it may converge over a 1-year period. It's a moving target.
Yep. And we're going to show you in one of the next graphs, the drawdown. It did decline about 4 or 5% when COVID hit 3 years ago.
I think that's the next chart, Steve.
Yep, exactly, the next chart. But it quickly recovered. It didn't decline for maybe it was about a month and a half, 2 months. And this is something we call a drawdown chart. What it does, it shows the difference between a peak in an investment to when it dropped and hit its lowest point. So in other words, we can see various times when, for example, the S&P peaked and the Vanguard Total Bond Market ETF peaked, and also when it dropped, and the difference between that peak and that valley. And so you can see the large peaks or the large drawdowns we've experienced in the S&P 500, but also the Vanguard Bond ETF, which dropped a lot last year, is down 16% or so, I think, last year. Whereas we saw hardly any drawdown in Lendex. And as I mentioned earlier, only a slight drawdown even in 2020. And even in 2020, we saw a large drawdown in the S&P. It did recover quickly, but it really experienced a lot of volatility in that period. And so that's the other nice aspect about Lendex. It hasn't had significant drawdowns, which is pretty amazing.
Well, it's been pretty stable. This year it's been a little bit wobbly, but not anything to get too upset about. But that's fine because it's not fully behaving like the stock market. The stock market is up, so it has its own sources of risk. We're looking for asset classes with different sources of risk, so that when one's going in one direction, the other's not going in that same direction.
Yep, that's right. And here's another chart that shows you, this is a nice way to show the comparison between the return and risk of an investment. And you can see the blue dot all the way on the left-hand side. That is actually Lendex, and it shows that it's returned, and this is, I think, 5 years, returned on average somewhat over 5% over the last 5 years, and that's 5% per year. And standard deviation, as we mentioned in the past, is a way to measure an aspect of risk, not all of the risk of an investment, an aspect of it, the volatility risk, because there are other aspects of risk that are not measured, quite honestly, by any statistic, but it does measure volatility risk. And Lendex has had an astoundingly low level of volatility risk. In yellow is, again, the Vanguard Total Bond Market ETF, and its 5-year average return has been pretty poor, around 1%, I guess. And yet it's also shown a volatility risk of about almost 5%, which is quite a difference between that and Lendex. And of course,
so Steve, can I just interrupt? Because
yeah,
I really think
absolutely.
that this chart is very, very difficult for the average person to understand. And I just want to make sure that they understand the lay of the land as they're looking at the chart. On
Sure.
this y-axis here is return. And so investments in the higher left-hand quadrant are preferable than in the lower. It's higher is better, higher return. On the x-axis, the bottom is standard deviation, which is how we measure the volatility of an asset class and how much it bounces. And so we like a low volatility because we don't want our investments to bounce all over the place, because we're trying to control them so that if we need to take money out or so forth, we're not taking it out as it's just bouncing along. Also, behavioral reasons for managing volatility.
Yes.
But so we want something on the left-hand side of this chart. So high left-hand quadrant is the best space for any investment portfolio to be in. Not that we don't want to have asset classes that are outside of that boundary, because we do. It all converges together.
Yep.
And as we find a recipe to put your portfolio in, we're actually able to reduce that volatility of those items that have that are more volatile, like the S&P 500. But you can see the difference between those asset classes.
Amazing. Now, the investment I wish we had here was the top left, that would earn 15% a year with zero risk, but it doesn't exist. That was a good explanation. Because this graph can be
when I look
can
at
be
it, I know
confusing.
that it's not easy to understand. That's why I had to back up.
Yeah, you're right. It's a good point. Yep.
So again, this is a really interesting asset class that we've started working with. We have been using Lendex. That is not the only choice, but from our standpoint, it is the best choice right now. And so we're sticking with it and continuing to monitor it and make sure that it's the right thing for your portfolio. We are looking for other types of investments with other continued diversification, and we have several of them that we'd like to discuss with you in another video as well. A lot of these asset classes, people would term alternative. We think sometimes alternative can be a little bit of a dirty word, because there's a lot of connotations that go behind that word. We tend to like to call this an enhancer asset class, because it enhances we're looking at, again, what can we add to the portfolio to improve return and reduce that volatility risk. And we think that this is a good asset class, and so far it's really served us well. So hopefully, if you have any questions about it specifically, we're happy to talk to you about it, and always happy to talk to you about your general portfolio as well and what's most appropriate for you. So thank you for listening, and we'll talk to you soon. Bye.